Rocket Holdings Incorporated, America's largest mortgage lender, had recently listed at the offering price of $18, which is lower than its target price of $22 due to its valuation from technology to financial company. So it's supposed to be listed as a financial technology company. However, it is changed. It results to 100 million shares issued or 115,000 outstanding shares once underwriters would exercise their option to purchase additional shares in full. Its flagship Rocket Mortgage, which now powered by Quicken Loans, a digital mortgage end-to-end processing, had provided more than $1 trillion in home loans since its inception in 1985. While growing their market share from 1.3% in 2009 to 9.2% in the first quarter of 2020, with compound annual growth rate of 19% according to their IPO prospectus. It means that we are buying or we are seeing the company that has been existent for more than 34 years, and yet you are able to get it at below $30. Without compound annual growth rate, for me, that's really amazing and promising to invest in. But let's see about their loan servicing. So it means the retention of mortgage. Accordingly, they had achieved overall client retention level of 63% and refinancing retention levels of 76%, which is approximately 3.5 times higher than the industry average of 22%. Meanwhile, in 2020, this year to date, their average has grown to nearly 75% overall client retention. Take note, we are on the pandemic and we are expecting a bubble or a financial crisis, especially to mortgage companies. It makes them to be recognized as #1 mortgage servicing by J.D. Power of the past 6 years. Moreover, their client leads increased to 80% since 2014, while refinancing is astonishing at 76% compared to 22% industry rate. So that is a 3.5 times of industry average. So by this, we can see that Rocket has that competitive advantage. Meanwhile, Quicken Loans was the largest mortgage lender during the first half of 2020, ahead from Wells Fargo, United Wholesale Mortgage, PennyMac, and JP Morgan Chase, as being reported by Wall Street Journal. According to their prospectus as well, they have a superior economic model as they had originated most of their mortgage loans to government-backed entities or to investors in the secondary market. In fact, 145 billion of mortgages they held originated in 2019, 91% were sold to the government. Therefore, it suggests to us that the risk to default is very low. So therefore, we can assure again that our capital investment to this company is being safeguarded reasonably. So what is Rocket Holdings Incorporated stocks with a ticker RTT in New York Stock Exchange is a buy? Before we answer that question, then let's look at their financial statements, checking their financial condition, profitability, and cash flows, as well as its fundamental analysis. Looking at their consolidated income and comprehensive income statement, we can observe that they have 46% increase on their net income in year 2019, having 892 million of net income compared to 2018 of 612 million. What I also love with this company is their salaries, commission, and team member benefits, which is 2 billion. A 41% of their total revenue in 2019 of 5 billion. Which is actually increased by 22% year-in-year in 2019, having a total revenue of 4.2 billion in 2018, in which it increased 1% from 2017's of 4 billion. Key metrics also is they able to increase by 68% of their 4.9 billion on gain on sale of loans compared to 2018 of 2.9 billion, in which it only have negative 13% increase. Actually, it decreased from 2017's 3 billion. As of 2019, looking at their combined balance sheet as of December 31, they have a 1.4 billion of cash and cash equivalents, including restricted cash, an increase to 29% compared to 2018 of 1.1 billion. They have a mortgage loans held for sale at fair value accounting of 13.2 billion in 2019, an increase of 129% from its 2018 of 5.7 billion. They have a total assets of 20 billion in 2019, an astonishing increase from its 2018's 11 billion. However, they increased their funding facilities of 12 billion in 2019 from 2018's 5 billion. It's just suggests to us that they are actually anticipating a high demand in 2019 as well as that could be carried over in 2020. So to me, that's a very good one. Total liabilities of 16 billion also increased from 8.7 billion in 2018. Again, that's primarily driven by the increase in funding facilities in anticipation for a higher demand in 2020, while they have a total equity of 3.5 billion, with that accumulated other comprehensive loss of 151,000. So, expect that this figure will change this year as they had their initial public offering, right? Looking at their combined statement of cash flows, we can say that they have a capex of $48 million, which is good because the company must continuously invest on their expansion. However, their operating activities is having a negative 6.9 billion, which is primarily driven by the proceeds from sale of loans held for sale against the disbursements of mortgage loans held for sale. Of course, they have to finance their growth. Meanwhile, their financing activities had 7.1 billion, which means that actually we investors has the assurance that this company would continue in going concern, as in 2019 they have that borrowings or funding externally of 14 billion. So in fact, they are not using the IPO proceeds to fund their growth because they have money from outside sources. Looking at its fundamental analysis, operating margin is 17.55%, which is 12% below than JP Morgan. That's fine because JP Morgan also offer a lot of financial services other than mortgage. They are also an investment bank. EBIT margin is 26.85% compared to JP Morgan of 38%. That's fine as long as we are in a positive position. And this actually one of the reasons why this company has a lot of external financing sources because of this key financial metrics and granting a loan. Its net margin is 17%. Remember, we are buying this company or stock of this company below $25. So 17% net margin is actually favorable to retail investors. And with their compound annual growth rate of 21%, we can expect that this one would be higher on years ahead. Asset turnover actually is way better than JP Morgan, having 0.08 compared to that GPM of 0.04. Meanwhile, our return on assets is higher than JP Morgan of 1.3% with 1.41%. Return on equity is 7.10%, a halfway low compared to JP Morgan of 14.91%. However, our total assets over total liabilities, or our total ratio, is 1.21, which is better than JP Morgan of 1.11. Debt to equity ratio is 4.73, which is not that far from JP Morgan of 1.24. Though to date, we cannot find yet the valuation of the company because due to data availability. However, I can say that this company is financially stable, having a strong balance sheet, and being profitable. With that being said, I can say that this stock is a strong buy below $25. Imagine we able to buy the company below $30, knowing that it's already a billion-dollar company, already have a positive operating results, already have that compound growth rate, and the increasing need for digital services. We all know that millennials and Zennial is coming into the market, and the millennials now are preparing to purchase their house. These people love the internet. They don't want to fall in line, and they don't want to go to the banks or any institutions personally. Therefore, Rocket Holdings, Rocket Mortgage, which operating in Canada and the USA, have that competitive advantage over its competitors. So, I would love to have this at below 30, strong buy below 30, a buy above 30 or below 50 with a target selling price of $80 to $100 in 3 to 5 years. I will going to hold this stock long term. So that's all for today, guys. If you like this video, please click that subscribe button as well as your like button and also your notification bell so that you'll be keep updated on my upcoming videos. Remember that I'm dropping a video twice a week. So you have the guidance or any advice, or you will learn something from me on your stock investing or in your personal finance and also in insurance industry. So see you next time.